Hello everybody, this is Louis from LoukProp and welcome to another episode of Real Talk with LoukProp. Now imagine this. Today you want to buy a condo. You're already committed to it. You paid the down payment, done all your calculations, and then suddenly you realize, oh no, I haven't factored in this expenses. I've made a mistake. So today we'll be talking about the 5 financial mistakes when buying a private property, and hopefully you won't make them. Let's go. So today we'll just be focusing on the mistakes that you'll make financially and not on things like choice of condo, so on and so forth. So let's go on to the first point. So for the first mistake that most people make, not factoring in reserve funds, not keeping these reserve funds aside for any emergency needs. Now, most of the people when they are buying a property, they take a look at their CPF, right? How much they have in their CPF OA, their cash, right? And then to combine this and put it all into a private property when they are making the purchase. Now, granted, this may be comfortable for you now, but don't forget you also have your installments to pay for. Although you can use your monthly CPF OA to pay for your installments and the remaining cash amount may be comfortable for you, but consider this: what if, touch wood, you lose your job? Right? If you lose your job, you won't have a monthly income coming in, you won't have your CPF OA contributions monthly, and you have to tank the entire installments by cash, which you might not have. So having this reserve fund acts as an emergency fund that helps you to tide over these installments on a monthly basis until you can find a new job. So mistake number 2 is not getting your loan eligibility checked before you make a purchase. Now this might seem very intuitive for some, but you may be surprised some people actually don't check their loan eligibility, thinking they can loan any amount that they want before they make a purchase for any private property. Now this is very important. If you already know how to calculate your own loan eligibility or you have gotten a banker to help you to do so, that's fine. But do you know that if you are calculating your own eligibility, there are a lot of factors that has to be included in the calculation. One of the most important ones is other debt obligations. Right? Other debt obligations that you have include car loans, student debt, things like your credit card loans, credit card payments, so on and so forth. All these affect how much loan you will eventually be able to get in the future. The best way for you to be able to get the highest loan you can is to clear all other existing debt obligations that you have, like your car loan, if you can clear it, your credit card, so on and so forth, and to maintain a very good credit rating, which you can check by paying a certain amount of money, like $5 to $6 on the credit bureau, to get your credit bureau report to see where is your credit rating at. The easiest way, of course, is to get a professional like a property agent to help you to calculate, or to get a banker to help you do an in-principle approval before you make the purchase. So for the third mistake, now understanding the timeline of your sale of your first property to buy your next property. So why is this important? Now, so imagine this. If you need the sales proceeds from the first sale of your property to make payment for your second purchase, alright, and it doesn't come in time, this means that either, number 1, you have to scramble for cash or other funds from elsewhere, or number 2, you might not be able to pay in time and thus incur what we call late payment penalties, which could be 6 to 10% of the amount that you need to pay for your next property. So in order for you to avoid this scenario, make sure that you understand the timeline well enough so that they match perfectly. So if you are unsure about the timeline of the sale of your property and the purchase of your property, we have done some videos previously, you can check those out. Link in the description below. Now for the fourth mistake, and this is especially for people who want to buy a resale condominium. We all know that buyer's stamp duty can be paid with CPF, but for resale condos, you have to pay your buyer's stamp duty in cash first, and then later get it reimbursed back from your own CPF later on. Now for some, this buyer's stamp duty might be a small amount, but take note, even for a $1 million property, your buyer's stamp duty is about $24,600. This is not a very small amount, it's quite a significant sum. So do include that into your consideration when calculating your sums for your cash and your CPF as well. So if you are curious about how to do your financial calculations, we have done some videos previously, very recently only. Do check those videos out, it's a 3-part series. Now for the last point, being unaware of miscellaneous costs. Now, most of you already know the major cost that comes with owning a property is your monthly installment. That's the biggest expenses you have when owning a property on a per month basis. But there are still other costs such as your maintenance fee, all right, your property tax, right? So on and so forth. So all these other peripheral costs needs to be included in your calculations as well, so that you know that on a monthly basis, whatever you're coming up with is actually comfortable for you. Let's talk about maintenance fee. Maintenance fee, let's say for a 3-bedder, could be between $300 to $500 per month. In some areas, maybe up to $800, $1,000 per month. That's very, very significant. For property tax, do you know that rental properties are actually having a higher property tax than owner-occupied properties, right? The difference in the percentage could be as high as 6 to 10%. For example, let's say your annual value of your property is below $50,000. Your property tax for that property, if it's an owner-occupied unit, is 4%. But for a rental unit, it could be 10 to 12%. So already the difference is about what? 6 to 8% difference already. So the difference in price or the difference in expenses could be pretty significant as well for property tax. So do factor all these peripheral costs in when calculating for your monthly expenses. So of course there are other things that we can talk about, but we'll leave it for the next time. Now for what we have discussed today, don't make these mistakes when you're buying a condo. If you like the video, click the like button, share the video, and of course subscribe to the channel. We'll see you in the next Real Talk. Bye. Click subscribe.